Okay, hello. Last video, what I went over was a brief summary of what I've been doing with investing along with Tank It. Today, I'm just going to be talking about investing. So the next few videos are going to be about my financial situation because I think it's important in understanding my stability. Um, and hopefully, if anybody needs help financially, I can refer them to these videos. So, I'm 15 years old, and I am in 10th grade. I'm in my sophomore year, and I will be going to college in 3 years, 2 years. I don't know. Now, what I want to do is start preparing financially for any debt I might have to take on, or any expenses that I might struggle to keep up with during my time in college, and of course save for retirement. And lucky for me, I enjoy investing. Now, number one, why do I invest? There are a couple of main reasons. First of all, I like it. It's fun. My great grandpa was an investor. Uh, that doesn't really have anything to do with it, but I like investing. Um, One, because I love research, and I love researching, and researching is basically just investing. Or, sorry, investing is basically just research and then acting upon that research, right? Making judgment based on that research. Um, Two, I want to set up myself up for college, as I said, and retirement. And three is I heard, or not I heard, from what I've understood, the sooner you start investing, the the more my wealth will compound. Now, I don't really want to get rich, right? That's not my goal. My goal is to be stable, financially stable, with no debts by like age 30 or something. Who knows? Now, let me just show you this compound interest calculator. Let me show you what I mean by starting early is better for compounding. So, let's say I compound quarterly. That's how much most dividend stocks compound. And let's say I start off with $20 a month and I go for 5 years with an interest rate of 11. Now that is the interest rate for the stock Ready Capital, right here, that I'm going to be talking about later. 11%, it's around 11%. And now let's calculate. So in 5 years, I will have made roughly $400. Now, I could increase the amount of money I put in here, right? I could, you know what, let's make it 200, right? That's 100 times what I usually put in. And you can see I've made around, that's around $4,000. So I've gone from making around $400 to $4,000, right? But that is not as important as if I start early on. I can put in less money than $200, but if I wait, let's say 50 years, that'll be when I'm 60, and I calculate that, you can see I will have put in $12,000 in total, which is the same amount that I would have put in 5 years with $200 a month. But I will have made, that's around 500,000, that's around 10,000. I will have made 490, around like $440,000 more, right? Now, if I upscale this to $40 a month, I will have made almost $1 million, right? That's a lot of money. But I have a 50-year time horizon. That will allow me to retire when I'm 60. Most people don't do that, right? So, that's the thing. I want to start early. So, one, retirement. Retirement is good for, or I mean, starting earlier is good for retirement. Two, what is two? Well, two is experience. I want to be able to invest logically, not with those get-rich-quick schemes that millennials do. Um, I want to be able to invest and be financially stable during college, right? Without having to rely on get-quick-rich schemes, which a lot of millennials fall into. So, let me show you how I stay away from that. So this is a list of stocks that I have taken a look at over the past few months, and here's some notes. I'm going to zoom in so that you guys can see. How the hell do I zoom in? Here, let's go 150%. You know what? Let's do 175%. Alright, so I have a note down here. So, just to make this clear, I am not investing yet. I'm going to, I don't know, I'm going to wait a couple of months until a recession hits, right? Because the yield curve just inverted, inflation is up, we're kind of bound for a recession. There's a huge tech bubble, which I explained in the last video. So, yeah, so many things that are just bound to cause a recession in the United States. So, and a recession, while horrible, is always the best time to buy stocks, because that means you can make double what you put in, which is great. And you can see this. Let's just go to SPY, and let's go through a 5-year period. You can see in 2020, when the pandemic hit, there was a very short recession where it dropped nearly 32%. And however much a stock price drops, however much percentage a stock price drops, you'll make double what that percentage is. Right? So it went down 32% in when it recovered. It made 46%, right? That's crazy. Right? So there's that. So when a recession hits, okay, so the whole premise of investing is buy low, sell high. And if you invest during a recession, that's buying low, right? Up here, this is not buying low, this is selling high, right? You want to buy low, so like right here, right? That means that increase is going to be a lot bigger than if, you just do this. See, if I invest when the market doesn't crash, it goes up, it's gone up like 23%. Over here, if I invested during the crash of 2020, would have made 100%, which is crazy earnings. So there's that. That's why I'm waiting for a recession. And there's so many things pointing towards there being a recession. It's pretty much inevitable. Now, I'm going to go through all of the companies that are orange, green, yellow, and yellow. So, and then maybe like one or two red ones. So let me just explain what these colors mean. Red means I've looked at them, not even thinking about it. I'm not even watching them. Orange means I'm watching them, right? Yellow means I'm watching them and I'm thinking about investing, or I have plans to invest, but I'm waiting for something to happen. Green means I am going to invest in it and I have a plan. In this case, green, I'm waiting for a recession to happen. Yellow, it's more like, yeah, I'm watching it. I'm not sure if I will invest, but I might. So, let's start off with JP Morgan. So my dad works at JP Morgan Chase. And you can see I have a couple of rows here, columns, that represent different things. First is the type. So the type is represented by whether it's a company or an ETF, or what kind of security it is, and then it shows what kind of growth or what kind of earnings, how I think I will achieve earnings through this stock, right? And then these 4 columns are just for ETFs. 1-year growth, 5-year growth in percentage. Then I put the dividend yield, then the PE ratio, then the expense ratio, which is only for ETFs, and then any positions I've planned, and then a few notes, right? Now, sorry about that. So, JP Morgan, my dad works there. Now, I was looking at this for a couple of reasons. Let's just take a look at their stock, JPM, that's their ticker symbol. Look over the past 5 years. Let's go to Google Finance. It looks nicer. Go over to Google Finance. You can see this is their data patterns. Now, let me make this clear. Don't click off because I don't just look at data patterns. But I do like Jamie Dimon. I really like Jamie Dimon, actually. Jamie Dimon, sorry. I really like him. I think he's a great CEO, most powerful banker, and he just seems really like a really great CEO. Now, they have a dividend yield of 2.94. That's the main thing. Dividend yield and PE ratio is what I was looking at. And then right here, this is a drop, which would allow for some swing trading. So if I buy down here, this would be buying low. And if it goes back up, then that could be really good for me. Now, the reason why it's in orange is because if we look at the earnings, or EPS, of JPM, there are two things, actually. First of all, seems like a very matured business, right? Without much room to grow. I mean, it's been around since 1968, right? JP Morgan and Company, it's just huge, right? And it seems like a fairly matured company. Second thing, if we look at their earnings, they've been declining for the past, 4 quarters. I'm not sure what that's about. We can do JPM earnings. Wait, JPM earnings, or we can do EPS. And we can see, yeah, it's been down quite a bit. So, yes, it did beat out the expected EPS, but if we look at it for the past few quarters, you can see quarter 1 of 2021, it reported 4.59, then 3.78, which is lower, then 3.55, which is even lower, and then 3.3. It just keeps going down. Doesn't seem good. So although the PE ratio may be low, which implies the stock is undervalued, I still think that it's not going to grow. I think that EPS might keep going down, and therefore the PE ratio will go up, not because the value of the stock will go up, but because the earnings per ratio, which is what the E represents, will go down, right? Which is the wrong kind of growth. So, yeah. And also, let me just make this clear. I don't invest in any companies I don't understand. That's why Costco's in red. That's why AMAT is in red. That's why RH is in red. That's why that's why like Whitehorse, or not Whitehorse. That's why PFLT is in red. Yeah. Anyways, I forget what PFLT was. One moment. PFLT. Let's see. This is Pennant Park Floating Rate. Okay, so they have a stock of $13, a dividend yield of 8.29, but they compound monthly, which is insane. But oh wait, their earnings are up like a ton. What was it that I did not like about it? I am not sure. It says they've been down 2%, but they've been up 12% in the past year, but down 2% in the past 5 years. Okay, let's see. I'm going to keep looking into this. I'm going to change this status to orange. Alright, because their EPS seems to have gone up really quickly. I think it might be a... Okay, it's an investing company. It's a small market cap public middle. Okay, I know there was a company that is a real estate investment, and it had everything was good, but it was real estate, and I'm certain there's a real estate bubble, which is why I did not want to invest in it. Okay, so PFLT, I'm gonna take a harder look at this company. I'm not sure why it's in orange, but I always try to narrow down my investments to 5 companies, or 4 to 5 stock, 3 to 4 stocks, in total. And I do not try to diversify. That diversification, to quote Warren Buffett, is a protection against ignorance. I just try to find a couple of companies, study them really hard, try to find like the best companies rather than just, I try to know a lot about a little instead of a little about a lot, right? So, okay, so Bank of America is next. Bank of America. It's got growth, but it's got an okay dividend yield. It's a pretty good PE ratio. It's a good PE ratio, not pretty good. It's a good PE ratio. But I just overall love their staff. They're adopting more digital platforms, and they're growing digitally, which is good because we're all moving digital. It just seems like a very, very, very stable company. Now, there is MU right here, Micron Technologies. Now, I actually do have some positions in it, but very, very few positions. Now, I like it because it's got growth potential. Everything checks out. The PE ratio, the 5-year growth, the not the dividend yield. Just basically everything points to it being a strong investment, except for one thing. They have a pretty shaky moat, a very unstable moat. Because although all their numbers look good, there's still Samsung, the giant company that is the leading in the industry. And although Micron Technologies is second, I don't see Samsung going away. I don't see any industry dominance. So I just do not believe Micron has a large enough moat for it to survive through Samsung and market dominance. PFLT I'm not going to go over because I'm going to take a closer look at that. RC, Ready Capital. I chose this one. You can see it's a dividend investment, and it compounds quarterly, which is really good. Has a PE ratio of 7.41, has room to grow. And I looked at their, I was looking at their, what do you call it? Earnings, their EPS, right? And it has been going up quite a bit. But it seems to be plateauing, which I'm a little nervous about. But other than that, they have an extremely high dividend yield. What we can actually do is go to a compounding interest calculator. I think I might remember why I did not highlight PFLT. We'll see. So let's do $20 here. Any dividend stock I'd be using for retirement, by the way. $20 a month. Length 50 years. Estimated interest rate is, let's just say, okay, this is RC, so that's this one. That's row 14. Dividend yield of 11, we'll just put 11. And this goes quarterly. Okay, so I will have made around $500,000. Now, PFLT is monthly, and this one has a dividend of 8.91, so around 8, I'll put 8.75, but this compounds monthly. So that's $500,000, and this one, Oh, what just happened? Oh, whoops. This should be 8.7. I'll just put 7.1. This one will be, okay, that's why I did not highlight PFLT, because RC was just simply a better dividend stock. Alright, so I'm gonna, you know what, I'm gonna leave that in orange, but I'm going to put a note beside this saying why this is not a chosen stock. RC is simply better. Alright. Now, PFLT, I don't think this data is right. Oh wait, no it is. Okay. Yeah. That's why I did not choose PFLT, because although it's a good stock, RC was just better. Put more money in the better things. It doesn't matter if it's a good stock. Always put your money in the better, not the good, right? Doesn't matter if it's good, if there's something better. Alright, so RC, compounds quarterly, has good dividend yield. Everything checks out. It's a really great dividend stock. Fairly stable. NU, New Holdings, New Bank. This is a speculative stock. It is the only speculative stock I will own, and that I currently own. I own like 6 shares. And New Holdings, I'm never going to buy any more stocks from them because it's a speculative stock. But my only concern is that it's got a lot of debt. But other than that, it's like they don't have to open physical locations because they're fully online. Oh, and also they're based in Brazil, which I don't really like. But them being listed on the New York Stock Exchange from Brazil, that shows crazy potential. But being based in Brazil isn't, in that case, is an upside, but just being in Brazil, period, is a huge downside because they're more unstable, right? They have debt. The second thing, but I really like their product, and I understand good product does not equal good business, but they have a good product, and that good product of being fully online allows for good business. What do I mean by that? Well, it being fully online, the whole idea of it being fully online and allowing it to, and allowing the user to invest, save, spend, take out loans, mortgages. It can do it's literally all of your financial things inside of one app, and all of that being online. That the reason why that's good for business is because that means that they do not have to open physical locations, which affects their business. That affects their balance sheet. That means that they don't have to spend as much while opening locations, giving them a huge advantage. Second, their product itself, which is the app, has brought in millions and millions of users in like Mexico and Brazil without any rewards for referrals. So it literally just grew insanely just from word of mouth, which is insane, right? Yeah. So that's New Holdings for you. It's speculative stock. I own some positions. I'm not going to increase my positions ever, 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 because it is speculative. I don't know if it'll exist in the future. It's based in Brazil, but it's got a really, really, really good business model and a really, really, really good product. Third thing is they do have competitors, which also makes me quite nervous. RH, gonna skip that. That's a shitty investment. Facebook. Now, this might be one that you were surprised to see in red. Now, there's been a lot of stuff about this. When you are judging Facebook stock, you have to really divide it into 2 categories. Facebook itself, or this is Meta. Facebook, the app, the social media platform, and their VR. Now, Facebook, the platform. What somebody described to me, when I was doing research, I realized, okay, so they had a huge stock drop. That's because a ton of users have left their platform, which is not good, because that means less ad revenue. But I then realized, well, they can just increase the number of ads on their platform, make up for that revenue. Yes, but their moat is is diminishing exponentially due to TikTok. TikTok is just simply a better platform. Facebook has lost its reputation. It has a bad reputation. Its owner has a bad reputation. It's just, yeah, Facebook is dying, and I don't see a future for Facebook anywhere. 2. This is the whole meta thing. I do not see metaverse succeeding with the current technology it has. I do see Oculus going very far, but the whole metaverse thing, I do not see succeeding. So if their entire business is mainly based on Facebook and just a portion of it is on VR, and the main portion of it is failing, which is the social media platform, I see their stock dropping a ton in the future, and I'm in it for the long term, not for the short term. I think short term it will do well, but long term I do not think it will. I also don't want to have short term capital gains tax, right? Okay, SCHT. This is a dividend ETF. You can see it's at $80. Now the reason I chose it was for two things: dividend yield and the growth. Unlike most dividend stocks like SCHT, you can see has relatively same dividends, but it hasn't grown at all, right? And growth is better for compounding, right? So it's just plainly better for compounding. So it grows, first of all, which means it's stable, but it also has a high dividend yield. That's 3.11, but this is 3.11 per every 30 days. That is literally a monthly compounding 3.11%. 3.11% of 100 is 3.11. 3.11% since it's monthly compounding. So it's times 12, one for each month, 12 for 12 months of the year. That's 37.32% per goddamn year on top of it growing. That's just insane. The one thing I don't like about SCHT has nothing to do with this ETF itself. It only has to do with the fact that I do not understand the business models of the company. However, it is managed fairly well. Its assets are shifted around fairly consistently. Its PE ratio checks out, and it has a low expense ratio for the amount of management that is done to the ETF. But I do not understand the businesses very well. But I'm willing to take my chances because everything else looks extremely well. The only thing is that if something goes horribly, horribly wrong, which is a very low chance of happening, I won't have the experience to fully judge. Well, I might not be able to make a great judgment if something horribly, horribly, horribly horrible happens. Because I do not understand their holdings very well, the companies within their holdings very well, but I'm willing to take that chance because I think that the pros outweigh the cons, and I highly doubt anything horrible is going to happen to this stock. I mean, even in the crash of 2020, you can see it dropped a tiny bit, dropped 4%, and that's it. Like, it wasn't even that much. And yeah. Okay, so there's that. IYW, last one. Waiting for a correction. This is simply just a growth ETF, and it's a tech stock ETF. All of its holdings are in technology. I understand technology, right? So essentially everything that SCHT has going for it, IYW has going against, but the one thing that SCHT doesn't have going for it, IYW has going for it. So their holdings, IYW, I understand the companies within their holdings because there's tech stocks, and as you know, I love tech. I'm a programmer. I understand it. I will know what to do. But here are the things it has wrong. Dividend yield is low. Whatever. It's a growth stock. So growth ETF. PE ratio way too high, and we're in a tech bubble. It's gonna crash. Expense ratio pretty high. But here's the upside. Look at the return. 35% return over 1 year compared to this like 27% return in all of the other ETFs that I have listed here. 43%, that's like double the average of all of the other ETFs I have listed here. 31%, that's double of all of the other. See what I mean? It has double the return. But again, we're in a bubble. So what I expect to happen is when the crash happens. Let's take a look at IYW. When the crash happens, it's going to drop massively. And when it drops massively, I can take advantage of that, pour my money in, and it will rise. I'll make like 10 to 1 returns or something. I don't know, 5 to 1 returns, who knows. I'll make it, I'm expecting like a 50%, I don't know, or yeah, 50% return, who knows. But I have to wait for a recession. And if that recession, if that never happens, if that scenario never happens, which is highly unlikely in my opinion for it not to happen, if that never happens, doesn't matter. I can put my money into other stocks. That's not my only option. And that's it. Keep in mind, none of this is financial advice. This is just me walking through all of my stocks, why I like them. Just kind of explaining my thought process. Again, waiting for a recession to invest. I've paused all of my investments, all of my recurring investments. Just waiting now. It's a waiting game. But yeah, thank you guys for watching. It's been fun. See ya.